Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning. So today's video is around what are the different types of life insurance that can be used to avoid inheritance tax. Welcome back. So today's video is around what are the different types of life insurance that can be used to avoid inheritance tax. Well, there's several different types that are available depending upon a person's circumstances to cover if a person, let's start at the most expensive, which is standard whole of life. Now, we usually use that. Some unfortunately inexperienced advisors just use this across the board, but it ends up being very expensive for clients in the long term and certainly can have a major impact upon their cash flow. So standard whole of life we use to cover the main residence plus chattels plus round about 50,000 in cash, presuming we can set up a person's finances to make sure their income meets their expenditure but plus some leeway. So therefore you need to cover yourself for the growth of the value of the main residence over time, and if that goes well over £1 million for a married couple or £500,000 for an individual, that's the amount you cover for this standard whole of life. But it can be 10 times in a person's when the person's 60 odd than a maximum whole of life. So the maximum whole of life we use for when people have got a whole range of other assets, be it properties, be it investments, and over the next 10, 20 years or whatever, they're going to give those assets away either into trust or to their children or utilising family investment companies and stuff like that. Okay, so if their intention is to give those assets away and then get it outside of their estate for inheritance tax, what happens if they die in between? And therefore the maximum whole of life costs significantly less money than a standard policy. But every 10 years, the value or the premiums could double or triple depending upon your age as to when you started. So in the long term, it ends up being too expensive, but over the 10-year period or 20-year period, it can be very effective to cover people while they're disposing of their assets in more tax effective mechanisms. And the benefit of a maximum whole of life opposed to a term assurance is that you have guaranteed insurability. So at the 10-year anniversary, the premium may triple, absolutely, but at least you know you can get insured. Whereas if you've got an illness in those in between 10 years, then effectively you may not be able to get policy somewhere else. We would always at that 10-year anniversary explore whether the client could get cheaper cover elsewhere, but if not, at least we know we've got the guarantee of being able to just put that policy and just keep that policy going, be it at the extendedly higher premium. Lastly, term assurance is utilised when there is absolutely no doubt that assets are going to be given away over a period of time and people just want to cover that period over the next 10 years or so of when they're trying to give those assets away tax effectively. So that's when term assurance is utilised, but at the end of the 10-year term, for instance, or 12 or 14-year term, we know that policy is going to stop and there's no guaranteed insurability. So for most clients, unless they're absolutely certain of giving assets away, that's not a recommendation as far as we're concerned in the general rule of things. Last but not least, if clients are giving away significant amounts of money well over their allowances, there's something called taper relief which applies when somebody gives away more than 325, their nil rate band allowance, the excess value. So if somebody gave away 625,000, 300,000 would get taper relief over the next 7 years. So we've got videos on taper relief as well. But effectively a gift into Vivos plan covers that time period while the amount of inheritance tax outstanding is reducing over time. So that's another type of insurance. You could also get renewable term assurance if you're worried, but again those tend to be quite expensive policies. So for the vast majority of people, it's standard whole of life together with maximum whole of life. So for some people, it's term assurance, but really this is individualistic advice which needs to be given by a regulated independent financial advisor. So hopefully you found that video useful. If you did, please give us a thumbs up. It helps the channel, and thanks very much for listening, and goodbye for now. Bye.